Welcome to the third lecture of week 6. In the last lecture, we characterized the optimal choice of a risky asset. We saw that if higher mean return is desired, then the proportion of the risky asset in the portfolio has to go up. In this lecture, we will see how we can measure riskiness of an asset. What characterizes quantitatively how risky an asset is. So it depends on how the asset's value varies or depends upon other assets' values. So, riskiness of an asset is a relative measure relative to how the value of the asset fluctuates in relation to the value of other assets. Example, asset A's value is, let's say, $60 with a chance of 1/4, and let's say $20 with a chance of 3/4. So how much would you pay for this particular asset? It looks like that the payment for this asset would depend upon the expected rate of return from this asset. So the payment should not be greater than $30 for an asset. Now let's say that asset B's value is $20 when asset A's value is $60, and is $60 when asset A's values is 20. Perfect negative correlation of values. So if you want to have both assets A and B, then how much should you pay for it? So it turns out that you would approximately pay $40, which is greater than $30, for a 50-50 mix of assets A and B. So how do you measure asset A's risk relative to risk in the whole stock market? It is given by this symbol, the Greek symbol beta. Uh, A is the asset that we have. The risk of asset A divided by risk of the whole market. So this is the proportion. So how much does the asset A's value vary in relation to the variability of the whole market? So in that sense, the risk of asset A is a relative risk. So how do we basically characterize this? So we say we look at asset A's return and we look at market's rate of return. So you can think of this as some index rate of return. Let's say Standards and Poor 500, uh, the rate of return on that. And this could be the rate of return on a particular share, let's say Apple. So I'm basically looking at how does the rate of return on Apple's share vary with the rate of return on the stock market, some index rate of return. So that is called as covariance, how they vary with each other. So that determines the risk of the asset A, but its total riskiness depends upon how this covariance turns out in relation to the variance, which is the variability of the total market rate of return. It turns out beta can vary between -1 and +1. So, for example, if covariance is perfectly negative between rate of return on Apple share, let's say, and market rate of return, which means that if the market rate of return goes up by 1%, then the rate of return on the asset A goes down by 1%. So it's one-to-one negative correlation. Then, in that case, uh, the beta, which basically gives you the riskiness of the asset, would be close to -1. On the other hand, if all of the variation in the asset is perfectly correlated with the whole market, then beta would be close to 1. If asset A's return is not perfectly correlated with the whole market's rate of return, And so it can be used to build a lower risk portfolio, then the beta value would be less than 1. And asset A would definitely lower the riskiness of the portfolio. Now, this is about one asset. What does this imply for the rates of return on all the different kinds of assets that we look at? Here, we just apply equilibrium principle. So think about it this way. If the risk adjusted rates of return were not equal between all the assets, then you could easily sell one asset, buy another asset, and sell for another asset, and profit between rates of returns. But then if you can do that, everybody else would be able to do that, which means this opportunity of arbitrage is going to vanish in equilibrium. And in equilibrium, all assets' risk-adjusted rate of return must be equal. So how do we adjust for riskiness? So let's be precise about it. So we know that the riskiness of asset A relative to total market risk is given by beta A. We also know that a total market risk is basically the variability in market rate of return, which is given by the standard deviation of the market rate of return. So what is the total riskiness of the asset A? That should be uh, beta A multiplied by sigma M. Now, if that is the case, we need one more piece of puzzle. What is the price of risk? And we saw in our earlier lecture that the slope of the budget line, which is Rm minus Rf divided by sigma m, is basically the price of the risk. It basically tells you how much should Rm go up by if risk goes up by 1 unit. So the cost of asset A's risk is price of the asset, price of risk multiplied by the riskiness of asset A, which is beta A into sigma m. So how do we adjust risk for asset A? So it turns out that this should be equal to this whole thing here, which gives us beta A into Rm minus Rf. So that's the risk adjustment factor for asset A. Okay. So the risk adjusted rate of return for asset A is going to be the rate of return on asset A minus the risk adjustment that is required for asset A. So at equilibrium, all risk-adjusted rates of return for all assets are equal. Therefore, the risk-free asset, for example, has a beta of 0 because it doesn't vary with the market at all. So its adjusted rate of return is just RF. Hence, what would be RF? RF would be the rate of return on asset A minus the rate of return, or basically the risk adjustment for the rate of return on risk adjustment for asset A, which leads us to this equation where rate of return on asset A is given as the risk-free rate of return plus certain risk adjustment for asset A. So this could be anything, and therefore this equation holds generally for all the assets. So any asset could be priced this way uh, if in equilibrium all the arbitrage opportunities have vanished. So risk, so the rate of return on asset A is equal to the risk-free rate of return plus the risk adjustment factor uh, on the asset A, which is the difference between the market rate of return and the risk-free rate of return multiplied by beta A, which is nothing but the relative risk of or relative variability of asset A with the market. So this equation RA is equal to RF plus beta A into bracket RM minus RF is the main result of what we call as the capital asset pricing model. The capital asset pricing model basically tells you that in equilibrium, if you think about any asset, that is how the asset would be priced. All right, so let's stop here. Before going on to the homework, I would urge you to do the third quiz so that we make sure that you have grasped all the concepts.